What's going on, guys? Welcome into today's show of Money Moves. Your host, Medier, as always, my co-host, Mr. Ryan Breedwell.
What's up, y'all?
We cover all things stocks, real estate investing, and personal finance to help you on your journey to $1 million and beyond. Before we dive in today, don't forget to check out the new millionairemindcast.com website. We got all kinds of great stuff up there for you guys. Of course, if you enjoy the show, if you're new to the show, we always encourage subscribe, be a part of these money conversations each and every week with us. If you get value from the content, all we ask, share it with somebody that can get more insights and value from being a part of the Millionaire Mindcast family. Leave a review. Of course, don't forget to take advantage of all of the freebies that we offer our community. The free financial x-ray, Mr. Breedwell. Every single week you offer the beautiful financial x-ray. What is that?
Yeah, sorry, I'm staring at this beautiful
Hey, if you're watching this live, let's just get that out of the way. So I just came off the mountain.
Wow.
From the tour of Tahoe one-on-one mastermind event. Shout out to my dude, Alex Ramon, who has got a residency, honestly, he's the largest magician in Lake Tahoe. But he forgot to magically bring you some sunscreen. Oh, both of us. It was funny. We got to dinner last night, and both of us have these big old white goggle eyes, and then the rest of our face is just beet red. That's hilarious. I'm rocking it today in pain, but you know how we do.
Free financial x-ray, y'all. What is it? It is, we'll take a look at your current portfolio. We'll kind of get an idea of what you're doing, what you're looking to do. What are you paying? What would it look like if you didn't run into me and I could maybe make some financial recommendations for you? We'll integrate your real estate. If there's potential to use like life insurance at any level, we'll kind of get that going. And we'll show you how that would work all together. Tax, from a performance tax perspective, and kind of get a stamp of approval that works from a percentage likelihood of it working. No cost, no obligation to go through anything. We just kind of have to have copies of all your statements, ask you a couple questions, get some stuff on what you're doing, and my team and I can get you onboarded and get that information to you pretty quickly. I normally have about a 5 to 10 day turnaround time on getting plans. So.
Yeah, and that's all free for anybody that just wants to dig in on your financial plan portfolio, make sure that it's doing what you would like it to be doing or should be doing.
Using life insurance, I had a gentleman that had a couple $100,000 as life insurance policy. We're doing a 1035 exchange, so there's stuff that you can do. A 1035 is just like a 1031. It's a like-kind transfer.
So you guys can take advantage of that by texting the word X-ray to 844-447-1555. You can see it up there on the screen. And shout out on the life insurance. How simple it is to take a loan out of your policy and invest it and make some money. So I'm making an investment into something that I'm actually going to be sharing with many of you guys here very soon. So if you're not on my deals list yet, you want to get that information before I put it out to the general public. I actually think I'm not even going to make it to the general public because it's going to subscribe and sell out so fast. That's how confident and excited I am about this one. But I'm taking a loan out of my life insurance policy. And it was like 2 clicks of a button, and I got my money, and now I'm investing it. I'm taking like a 3%, or it was like 2.75, 3% loan.
3%, yeah, 3%.
3% loan to pull on my life insurance policy. The investment I'm putting it into is 12%, and that's annualized. So I'm going to
9% arbitrage guaranteed from that, with the potential to pull more from your policy.
Freaking amazing.
Shocker.
I love it.
Yeah.
So that's really, really cool to be able to do that. And for those of you that, have your life insurance set up, thinking about how you can play that arbitrage game strategically. And if you don't have your life insurance policy set up, that's where you take advantage of the free financial x-ray. And if you want to look at more deals and opportunities,
get on that list.
Get on that deals list. So just text the word deals to 844-447-1555. That being said, we got a lot of data to sift through this week. We got the Fed potentially turning their attention more towards the banking industry right now than fighting inflation, or at least that's what a lot of the bears would like to have you believe. And we're going to talk a little bit more about that. We've got Ray Dalio's take on the banking industry and many other prominent kind of financial influencers, and yet they may be pounding on that same drum that ultimately is something that is probably not aligned with where your take is in terms of where the economy is. So I want to get your take on that here in a little bit. We got affordability housing data that came out. We've got new home sales. We've got prices in terms of median home prices, all data that came out, which is, I think, really telling about where the market is going. So we're going to dig into that today as well. That being said, let's recap real quick on the SVB collapse, First Republic, now Credit Suisse, and all of these narratives. Let me read you a couple of these so you can give us the hot take from Mr. Breedwell.
All right, let's take it.
Well, first and foremost, Silicon Valley Bank, as they continue to dig in and pull back some of the layers to the onion, there's more there than what met the eye initially, and what some of the concerns and what smelled a little fishy is starting to get validated, it sounds like, right?
Yep.
And so loans to Silicon Valley Bank officers, directors, and principal shareholders, as well as other insiders, more than tripled to $219 million in the final months of SVB, which is a record amount going back at least 2 decades, which is something a little bit unusual. The bank chief executive officer, Greg Becker, just hired defense lawyers for a big lawsuit that came about accusing him and the bank and their executives of securities fraud, giving bad information. Now you're hearing, people talk about Credit Suisse being in a really big, very similar kind of crisis when it comes to
They're a penny stock now.
How they were positioned. We've got economists saying 186 banks similar to ones like Silicon Valley Bank may be prone to similar risks. Ray Dalio has called the bank turmoil a very classic event in the very classic bubble bursting part of a short-term debt cycle. We've got Ken Griffin, founder of Citadel, saying we're set up for another recession unfolding. Yeah. We've got Priya Misra talking about the Fed has no choice to push the U.S. into a recession. And then we got our good old Janet Yellen saying, you know what, the U.S. financial system is the safest and most liquid in the world. Calm thy nerves.
What a good old grandma she is.
What do you say to all of the people that are freaking out about what is ultimately some major mismanagement of bank funds?
Definitely, yeah.
But is it really fracturing the financial system the way many are claiming it to?
Obviously not. Consumer sentiment
Speak some wisdom into
consumer sentiment is still at an all-time low, I would say, for not all-time, or there, historically we're in a low area to where we want consumers to be in. But as I've said multiple times on my Twitter, go follow me at Sacktown Assassin.
Are you talking some shit on Twitter these days?
I always am keeping people in line. But what I'm trying to do is just a lot of these, people that have these profiles that hide behind these fake names, this and that and whatever. I don't try to sell no courses or anything. I'm just on there telling my opinions. It's all a bunch of just lines. People really like to rely on lines and think that they can lay over lines. I can't tell you how many charts I saw of people for the last 4 or 5 months overlaying the 2008 S&P 500 and how it was so correlated. Now everybody stopped that because it's no longer correlated. I mean, you can find a story kind of like when we were back in COVID and fit it to your narrative whenever you want it. It just doesn't mean it's going to pan out. I think a lot of people are getting the banking thing with SVB and Signature Bank and Silvergate all kind of messed up and thinking that it's a 2008, and they're just not the same. They're the same size banks almost in value in 2008 numbers, but you need to have a couple $1 trillion in assets to be a systemic part of our banking system. Just to catch everybody up as well, Credit Suisse has 0 ties to our financial systems. That is a European bank. They have nothing to do with our financial system.
And why have they been bringing that up, right? Is it because, this is more of a globally interconnected financial system than people may think it is?
Historically, Credit Suisse, I would say up until and through kind of the dot-com bust era, was considered a high-quality place to put your money. So I just think that those names might be losing some of their steam, and you're going to see that some of these smaller banks ultimately get absorbed by the larger banks, which would ultimately happen kind of anyway.
Is that a bad thing, though? A lot of people talk about the emphasis and importance of our regional and, smaller banking institutions. And I guess my question to you from your perspective would be, is that a bad thing of those getting rolled up into bigger banks? Or is it something that ultimately is being overemphasized and not as big of a deal for small businesses and companies that get a lot of their banking relationships from those regional players?
Yeah, I think that the idea of regional banks is extremely important, but I do think some of the larger banks will probably absorb the smaller banks, and then they would likely be forced by regulators, or I think it'd be a smart business decision to tranche the business lines and say, hey, we're going to have this. This is JP Morgan Chase, but this is going to be, a different name of something. It's, something by JP Morgan Chase, and that's their regional banking arm. And they maybe have a little bit looser around the belt for some of the things that specific area works on. Maybe in the Midwest, they are agriculturally focused. Maybe on the coasts, they have a lot more marine and shipyard financing and stuff like that. That's maybe more specific to just that bank in that area. But ultimately, a lot of the banks that are small are just kind of stagnant in growth and aren't really doing much. And besides providing a personal relationship, which I think is what a lot of people don't want to lose, and kind of that hometown feel, I don't think they're providing much more than the current banking system is by a large lender, minus, as I was saying last week, I think larger banks and banks as a whole need to start paying more yield and should be required to by law to their depositors, because right now I was looking at some of the yield like on my savings account at Chase for my business is like 2 basis points. And there's a lot of money in there for expenses and taxes, and I'm not getting anything. And I know Chase is using that money and making a lot of money with it. I think there should be a happy medium to where people aren't getting dragged so far over the coals. And I think that would also help with depositors not having these runs on withdrawals, which is what's been happening to most of the banks.
Has there been any major runs that have really stressed any banks beyond,
First Republic had a little bit of stress, and they reached out to regulators and let them know, hey, we're financially sound to our held to maturity securities. We have really high quality loans out to corporations and a lot of institutions. We have a small but healthy mortgage portfolio. But we would probably do well having this injection of capital if it was at all possible. And that's where they got about $5 billion from the big banks. And that's
they got that from what, JP Morgan?
JP Morgan, Wells, Citi.
You know what I find? I think this is a perfect example, and it may not be what certain people want to hear. I don't mind it because you don't hate the player, you hate the game kind of thing. And I think if you can learn how to play the game correctly in terms of money, you're going to stumble into opportunities and be capable of taking advantage of those opportunities in a way that will change your financial future. Mm-hmm. The big grand scheme of what, let's say, Wells, JP Morgan, and whoever else, their stock was really low, right?
It was getting hit.
First Republic was getting hit.
Oh, yeah.
In a big way.
Oh, yeah.
And what I'm saying is ultimately there were a lot of people who understood the game that was being played in that moment that bet on, with their kind of financial savviness and literacy, that the bank was going to do really well and make a comeback, especially when you got big players backstopping it and giving their vote of confidence and financial support.
Yep.
And therefore, the people that had the wisdom and the understanding of the game and the capacity and capability to invest in the bank at that point in time, they did really damn good.
I know somebody that did.
Yes.
And it's I know that bank is going to be around for quite some time. And potentially. There still could be anything can happen.
Yeah, right.
But there's
But I guess what I'm
JP Morgan essentially has stepped up and said that they would backstop that bank if it needed to.
Right.
And
so
I don't think they're going to need to.
And all I'm saying is that's just one example, right? I think it's a recent example, and it's a prolific example of if you're an investor and you have put in the time and the energy to build up the right resources and team around you, to have the right skills and knowledge to make informed and educated and disciplined decisions and you understand the space and the game that you're playing in, whether it's real estate investing, when an opportunity comes that, may seem risky or scary to some, but you have the right counsel, you have the right resources, you have the right, disciplines that put you in a position to capitalize on that, whether that was in 2020 in the stock market, whether that's something like right now that's going on in certain areas and sectors of the industry, whether that's in crypto. I don't know. I'm just saying being an individual that is playing this game and working to build skills and resources and disciplines in this game, if you play it long enough, if you're consistent enough and you are diligent enough, you're going to come out ahead. And so I just thought I think we're heading into a season where there's going to be more of those. There's always those opportunities around, but I think there's going to be more of those opportunities in abundance just because of the current climate and landscape that we're heading into. What are your thoughts on that?
I'm extremely excited to get towards the end of the year because I think the market's going to have a really aggressive rebound and have something that's like I think what people are discounting or too heavily putting in right now is a pivot, but I do think there's going to be rate cuts. I might have even undershot it, like I said, to 0.75% by the end of the year, but even up to maybe 1% by the end of the year. And that's what the Fed futures is saying right now. And I think there's probably going to be, am I jumping the gun on getting the interest rates?
You can do that.
Okay. I was going to say, I think there's probably going to be an interest rate hike of 0.25% the next meeting. And I think maybe at the next meeting and meeting after, they're going to pause and kind of cruise and see what happens and really let the data catch up to itself, because what I've been saying has now started to pan out and show that there is more, the lagging data is catching up to what we are currently seeing. I bought 18 eggs yesterday. It was $7.
Oh, baby.
It was $13 a few weeks ago. So things are, inflation and supply chain is starting to catch up on itself. And I know that eggs is just a funny one to talk about, but I think that everything is starting to come back in line. Interest rates have snapped down a little bit. Bond market, bond yields, the 2-year, the 5-year, the 10-year are way lower than they were, almost 100 basis points below where they were just 30, 45 days ago. So we're having better outcomes than I think I even anticipated, but it is leading me to still really feel strongly that we should have interest rate cuts at the end of the year. That's interest rates going down is good for the stock market, good for people getting into the real estate market because you got to leverage into it. And so everybody's going to start winning again. And I'm really excited for that day to come because, gosh, it's been exhausting about 16 months going through this technical recession.
Yeah, I mean, from Goldman Sachs, and we got a question from Jesse that we're going to get to here a second. Guys, feel free to input your questions live, and we'll be sure to try and get to all of those that we can. It sounds like the inflation problem actually is becoming I don't want to say less urgent now than last summer because near-term inflation expectations have really fallen sharply, right? And we're starting to see some of that data catch up, like you said. At the same time, you don't want to see the Fed taking their eye off the ball too much with that, right? So it sounds like they're going to continue to raise rates to the point where raise rates. Let's see if that data catches up. Ideally, they kind of said they want to get it up, the Fed funds rate up to 5.25%.
I think they're going to reassess that to 4.75, 5.25, and we're going to be ahead of that. They're going to notice they're going to be ahead of that if they don't cut come likely around July time.
Yeah, because the Fed's kind of tight-roping a tough act. They're trying to fight inflation, and all of a sudden now there's all this uproar about SVB and the collapse of the financial banking system. And now all of a sudden, over the course of the last week, in light of all of this, your favorite conversation and topic.
Yes.
Crypto.
I don't hate
Balaji Srinivasan, I hope I'm saying that right, billionaire entrepreneur and investor, has set crypto Twitter on fire by predicting that Bitcoin will hit 1 million within 90 days. He believes most banks in the U.S. are insolvent, hyperinflation is imminent, and the U.S. is going to see a civil war.
Most U.S. banks are insolvent.
I mean, this guy is obviously very positive on the U.S. as a whole. But this kind of ties into Jesse's question. I think you and I are both of the camp that no chances crypto or Bitcoin gonna jump that way. That being said, just give your quick thoughts on that.
I just don't like Bitcoin because what Bitcoin wants to be and needs to have to achieve that is not something that the federal government will want or allow, nor do central bankers want or will they allow. So just swallowing that pill can kind of suck a little bit when you want to be in that type of, have that type of anonymity and blockchain technology. What I think that the crypto space has done for the financial system as a whole is it's going to improve it, because blockchain technology needs to be adopted by the finance system, by the real estate system. I think that NFTs have a really good space for contracts, or for keeping like personal data like an ID or a passport, something personal that's safe that only I have that's where that technology goes. But when somebody has a technology and they say, no, it's going to be for Bitcoin and it's always going to be for Bitcoin, there's a couple problems. One of the outreaching problems, and a lot of people bring this up as maybe a problem for the banking system as well, is too few people own too many Bitcoins. And that is just a fact. And the other thing is, a lot of Bitcoin, not a substantial amount, but a percentage that is enough to talk about, is lost in wallets and cold storage that can't be accessed anymore due to people forgetting the keys, locking it up too tight. And that's just not something that we should have. That systemic risk should not be there. Is our current financial system perfect? No. I think it's long in the tooth and it needs to be updated with the way that we currently do banking and do finances. But is crypto the answer as it currently stands? No. And we can see that with the FTX collapse. We can see that with still a lot of transactions used for Bitcoin are typically fraudulent, even though a lot of people use it for a good reason. I'm not pointing fingers at anybody. And I'm not saying one cryptocurrency is better than the other. I prefer things like Ethereum. I have Algorand. I have some Solana. I have Polygon. I have Ripple. I've had Ripple for many years. Those are the types of projects that I have some of my money involved in. But I don't have any money, nor will I ever have any money in Bitcoin, just because it's not something that I personally, and I get some behind the scenes info too, and I see what regulators are trying to push through as far as what they want to do to Bitcoin specifically. And we can get a taste of that looking at the SEC case with Ripple. Ripple's likely going to come out above on it, but it's been years that they haven't been able to trade that asset, use it in the United States, and that just is a glimpse of the power that regulators have for that asset class. So I would caution anybody away from Bitcoin, but I think if you want to speculate with a small portion of your money, I have about less than $10,000 in crypto, and I don't mind anybody knowing that. I have a lot more in individual stocks, and I'll keep doing that, and real estate.
Yeah, I think that ties into Jesse's
life insurance
question here, which is, relating to, like, you're obviously not a fan of Bitcoin, but you're not a fan of crypto as a whole. It's just got a long ways to go in terms of utility, functionality, and really having rules to...
Bitcoin tanking, Jesse, was its test to see if it was a hedge against inflation, and it's clearly not. It had its chance to kind of do that this year, and so did gold, and gold didn't do super hot. So I don't think there's really truly any hedge against inflation. I just think that real assets typically appreciate better in high inflationary markets. But Bitcoin has no something that you always have to come back to is, and I was having this conversation with another person on Instagram. What is Bitcoin worth? It's worth something, and the units that it settles in is dollars. You're ultimately always going back to dollars. You're going to a fiat. You're settling in a fiat currency. So Bitcoins are never going to be worth Bitcoins, and that was what it would have to be for it to be what it wants to be, and that's just never going to happen. So my recommendation, there's a lot of down companies and stocks that are down a ton. Matt and I both have individual stocks that are up over 100% through this current market environment. A lot of stuff that is down as well. But I would buy some stocks and actually buy stuff that I know it's not sexy, but I promise you, besides the people that are flashy on the internet, there's no super rich people with a ton of money in cryptocurrency. There's just not. And there's a reason for that.
That being said, on that same narrative and vein, I think it's interesting to see the recent release of Existing home sales data.
Yeah, up way more than expected. Expected to be up.
Increased to, it blew out expectations. Increased to 4.58 million.
10% increase versus about a 3% increase.
14.5% increase.
Is that 4?
In February.
Well, no, it was 4 million prior, and it was 4.5, right?
4.58, yeah.
Dog, I don't know what universe I'm in, but I believe that 10% is about 500,000 is about 10% of 1.
Existing home sales surged 14.5% in February.
I'm just doing pure math. Tone, am I crazy over here? Is that at least sounding like I'm not crazy?
I'm just reporting out of Calculated Risk blog, so we'll double check that for you guys.
Calculated Risk.
That being said, the median existing home price for all housing types in January was $363, which is a decline of 0.2% from February of 2022. This drop in prices, though, ends a 131 consecutive months of year-over-year increases, the longest on record, which is pretty wild. So we talked about being in the 8th and the 9th,
almost
and the 10th,
12 years,
11th extra innings, right? And
that's 11 and a half years.
Talk about a bull run, right?
Wow,
now
way longer than the last stock.
So this is what I found to be really interesting is existing, and this again we'll double check this, but existing home sales surged 14.5% in February, ending a 12-month streak of declines.
I think I'm saying that from the prior report is what I'm saying, because 10% of 4 million is 400,000.
There you go.
Yeah, that's what I'm saying.
So what's interesting to me, I think, is especially with kind of the whole sentiment in the market, with inventory being as low as it has been, right? Active single-family inventory was up week over week, 0.4%, nothing big, but still down almost 50% from 2019, same week.
Yep.
Is people are really banking on real estate long term. If they don't feel comfortable with what's going on with the stock market, if they don't feel comfortable in other investment opportunities or vehicles, they're still banking on real estate being one of the best stores of value for them in terms of their personal residence, whether it's an investment or not. In that perspective to them, it still shows that even in this climate, even with rates as high as they were, and we did obviously see a drop in rates the last week, but still that's not going to encompass all of February numbers. Home sales surging almost 15% in February. I don't want to say it's shocking to me, but it shows that there's still a lot of confidence in the housing market altogether. And also, I'm sure a little softening of prices are bringing people back into the market with the rate softening up, prices softening up based on what data we're seeing here, but existing home sales jumping 15%. That's pretty aggressive.
Yeah, inventory just being as low as it is, too, is going to keep that driver moving that way for as long as...
100%. President Lawrence Yun, chief economist of National Association of Realtors, basically noted because of how little inventory we do have, and with that little drop in rates, multiple offers are returning on a good number of properties. So depending on what happens with rates by the end of the year, depending on how all this data catches up, we may not see a very big drop in the real estate market at all. We were talking 10, 13, maybe 15%. Now I'm
still keeping my 13.
We're seeing adjustments of, different authorities and data providers, ranging from 4 to 8% now. So it's going to be interesting to see. But I think at the end of the day, if people keep waiting for these black swan catastrophic events to get in and get started, and again, going back to why we don't try and time the market, it's going to continue to run.
Our inventory will likely catch up when interest rates go back down. There's going to be a flood of people that will sell. And so it'll go back to being like a buyer. It'll still be like a buyer's market because there'll be and that's our inventory is going to be existing inventory. It's not going to be new builds like it was through COVID. They tried to build to catch up. It'll be people that bought in 2019, bought in 2020 that now are at their cap gains waiver and can sell these houses and move to different areas because it was their first home, it was their second home, they want a custom home. That'll be the pop in the inventory because we can't build fast enough to catch up with inventory. No. It's feasible, sure, if we were China and we could use forced labor and make people work 19-hour days. We can't do that though. So the way that the inventory is going to catch up is organically through people saying, hey, I'm going to sell my house and buy another house that already exists from somebody else, the old school way. It's not going to be, hey, home builders are popping out 1.9 million new homes every month and we're finally catching up. It's just not possible for them to do that.
A crazy statistic that I found really interesting from Black Knight data, which is ultimately one of the largest mortgage providers, if not the largest mortgage provider of data on the overall economy as a whole. More than 40% of all U.S. mortgages were originated in 2020 or 2021 when the pandemic drove borrowing costs to historic lows and triggered, right?
Boom. Yeah, it's not going to be a refi boom like people are thinking that, oh, yeah, interest rates will drop. There'll be another refi boom.
No.
If you were thinking about becoming a lender because of that, heed our warning. That will not happen.
That being said, if you find, again, good opportunity, something that meets your buy box or your investment criteria, or it's something that you plan on staying or being in for quite some time, and it works and it pencils and you can, ultimately sustain through an extended period of time, no matter what rates do. Now, if they cut lower, right, now you're looking at obviously a good opportunity to increase a margin or lower your costs in terms of your rate and your payment dropping. So there's opportunities out there still. I mean, I'm seeing and talking to more and more people right now that are seeing more and more distress in these little micro pockets. And that ultimately is coming back from a lot of investors who did poor underwriting, thought this blue sky was going to continue to run forever, rents were going to continue to climb forever, home values were going to continue to run forever. And ultimately, with a lot of that changing, it was how long, you heard that statement, when the tide goes in, you see who was swimming naked. Many people were swimming and scattering and trying to, do whatever they could in the meantime to try and fix some of these things. But I've heard of some pretty big opportunities of individuals in my network that, and these are, again, starting on the higher levels, they will work their way down into smaller and lower levels of investment opportunities. But some of the big players and some bigger opportunities are starting to show cracks and starting to work themselves out. I'm seeing people, give up GP interest. I'm seeing people, ultimately hand opportunities back off to who they partnered with or invest the banks that they had short-term debt with. There's some interesting stuff happening right now. So just be paying attention to that, because obviously I'll continue to keep you guys posted on what I'm hearing and what I'm seeing. But I think there's going to be more of that stuff happening in the coming months. And obviously, depending on, again, what does the Fed do? What do rates do? What is the economy as a whole? What is, there's so many moving pieces in this overall puzzle, right now. It's just hard to really.
Yeah, nobody's ever been here before.
Yeah,
the fun part about it is nobody's ever been here or gone through this again. So I sound like a contrarian a lot just because I might have a fresh perspective, but the fresh perspectives are panning out a lot more than the old way of doing things. I just think we haven't had QE for a long time. It's less than 20 years old in our financial system. So a lot of the stuff that people look back and model off of is not as accurate as the last, let's call it 14, 15 years of data to look back out and model as. So nobody's really been here before. Nobody's gone through a market like this. This will be my first time going through it. But the thing we can do is make best guesses based off of what is happening, what has happened, and how does that apply currently and look moving forward. My guess is, again, that the S&P is going to end somewhere around the 4,400 zone. That's another 10% move on the S&P before year end, and I'm sticking with it.
I love it. Well, you guys heard it here first. We appreciate you guys tuning in live. I know you guys wanted to see the goggle tan and, the bright red face. So, of course, I'm rocking it in style. I walked into the Subway to get my sandwich 10 minutes ago, and the lady goes,
"You got Subway?"
Yeah,
I'm about to go get some.
Yeah, absolutely. I gotta keep the fuel. I came straight from
I've
the
been
mountain to
feeding-
here.
I've been feeding two right now.
I'm dedicated. Yeah, you do with
I
that
got this
caterpillar
thing
on
right
your
here.
lip. That's for sure.
Yep.
But she laughed and she was like, "Oh, you were on the slopes, weren't you? You had no sunscreen for you, man." So it was,
Should tell you about a summer sausage as well. That's a beer fest joke for anybody.
Okay, I was like, I missed that one, and no, she didn't talk sausages with me. But if you guys enjoyed today's show, be sure to leave a review, share it with a friend, a family member, somebody that can get some value from being a part of these conversations. I appreciate you guys tuning in live. This is fun. Love the questions coming in. We're going to continue to keep serving you guys as best we can, and we're an open book. So we will
we are.
give you our best guesses. We will try and get through and sort through as much of the data as possible so that way you don't have to take your precious time to do that, and ultimately distill it down into something that is valuable for you in terms of making money moves that serve your financial goals. So if you're not subscribed, don't forget to subscribe to the channel. If you haven't taken advantage of the free financial X-ray and you want to connect with Ryan and his team, you can see there on the screen. Just text the word X-ray to 844-447-1555. My investment opportunity that I'm extremely excited about, something I've been working on for about 8-9 months. We're going to be opening this up. I know it's going to subscribe and sell out because I'm only taking a certain amount of subscription on this first go around because we don't want to go too big too fast. That being said, if you want to get notified of what that is, I'll be sharing more in the the coming weeks, but you can text the word deals to 844-447-1555. And if you're not on my text letter, text the word notes, 844-447-1555. That being said, appreciate you guys. Keep investing in yourself and your wealth on your march to $1 million and beyond. Cheers.
Cheers, y'all.